Imagine waking up one morning and realizing the world has quietly shifted beneath your feet. The currency you thought defined value, stability, and strength, suddenly, it's just one of many. That realization is not far away. It's already happening. The global financial architecture is evolving faster than ever, and the trust we've long placed in a single monetary system is being tested in ways unseen since the Bretton Woods era. For decades, the world has been built around a single reserve currency, but history tells us no system remains dominant forever. Innovation, technology, and geopolitics are reshaping what money means, how it moves, and who controls it. Every few generations, the world redefines value. Gold once anchored the system. Then, the dollar took the stage. But today, digitization, decentralization, and data are becoming the new pillars of trust. The future of money won't be issued by one country or controlled by one authority. It will be distributed, transparent, and driven by efficiency rather than power. The global economy is too interconnected, too dynamic, and too fast-moving to rely on a single point of control. The cracks are already visible. Countries are diversifying their reserves. Cross-border trade is being settled in local currencies. Digital payment rails are bypassing traditional systems. The rise of blockchain infrastructure, digital wallets, and tokenized assets is no coincidence. It's a response to inefficiencies that have accumulated for decades. When you see technology outpacing policy, it's a signal the future is forming outside the old rules. This shift isn't about panic, it's about preparation. Over the next decade, as monetary systems evolve, those who understand and adapt will lead, just as the internet democratized information. New financial technologies are democratizing value. They're unlocking global liquidity, transparency, and speed that were previously impossible. This isn't the end of traditional finance, it's its reinvention. But reinvention always starts with a loss of certainty, and that's where opportunity hides. Think about it, innovation thrives in disruption. Every major transition, from industrial to digital, from analog to exponential, creates short-term volatility but long-term growth. The same is true for currencies. As the global system diversifies, value will migrate toward assets and technologies that can endure beyond borders. Real innovation doesn't rely on the stability of one nation's balance sheet. It relies on solving real problems for a global population. The most resilient economies will be those that embrace optionality. They won't bet everything on a single system, asset, or currency. They'll build resilience through flexibility, by holding assets that represent productivity, not promises. In this next phase, value will be defined less by what governments guarantee and more by what technology enables. The question isn't which currency will dominate next, it's whether dominance itself is even relevant in a decentralized world. We are entering a new financial era where efficiency replaces exclusivity. The winners will be those who understand that value is no longer confined to one currency, one asset, or one market. It's flowing toward networks that are faster, smarter, and more open. We're seeing the birth of programmable value, money that moves at the speed of information, verified by mathematics instead of intermediaries. That is not a distant dream. It's happening in real time. This transition will challenge old assumptions, especially those built on comfort and control. But like every paradigm shift before it, what begins as uncertainty ends as progress. The same way electric vehicles disrupted the auto industry and artificial intelligence is reshaping labor markets, the financial system is about to experience its own revolution, driven by transparency, efficiency, and inclusion. So, don't rely on one currency. Don't rely on one system to define your future. The next era of growth will belong to those who diversify not just their portfolios, but their thinking. Look beyond what's familiar. The opportunity lies in the friction, the shift between the old and the new. In every age of transformation, most people cling to what they know, but the visionaries look at the cracks and see light. They see systems evolving, technologies converging, and possibilities multiplying. That's where we are today. A world where money is no longer confined by geography, where value creation happens at the intersection of innovation and trust. The message is simple: adapt before you're forced to. The next financial evolution isn't coming, it's here. And the greatest risk is not in change, but in standing still, hoping one currency, one model, or one institution can hold the weight of a rapidly changing world. The next wave of prosperity will rise from diversification, of systems, of ideas, and of value itself. The old framework may resist, but progress doesn't wait. It moves forward with or without permission. The world is signaling a reset, and those who see it early will not only protect their future, they'll help shape it. That's the opportunity hidden in uncertainty. The next chapter of global finance won't be defined by fear, but by freedom. The freedom to think beyond one currency, one economy, or one belief about what value must be. The future belongs to those who prepare for it now. When uncertainty dominates the headlines and volatility defines the markets, one truth quietly endures: real value always finds its way back to real things. In every cycle of expansion and contraction, the assets that stand the test of time aren't the ones built on speculation or leverage. They're the ones rooted in tangible utility, innovation, and scarcity. Throughout history, when financial systems stretch beyond fundamentals, reality eventually reclaims its power. And today that moment is approaching once again. Owning real things isn't about nostalgia or retreating to safety. It's about recognizing where true productivity originates. Real value isn't created by financial engineering, it's created by solving real problems. Whether it's a company developing next-generation batteries, a technology that connects billions, or infrastructure that powers a digital world, those are the assets that will endure long after short-term trends fade. In an economy built increasingly on data, algorithms, and liquidity, the irony is that tangible creation has never been more valuable. Think about how innovation cycles work. When the world overextends into speculation, when prices detach from fundamentals, correction follows. But that correction always clears the way for a stronger foundation. The innovators keep building, the visionaries keep creating, and that's where lasting value is reborn. The future will not belong to financial illusions. It will belong to those who own the means of real progress. The lesson is simple yet powerful. Own what can't be replicated by policy. Currencies can be printed, promises can be broken, but a productive asset, whether it's technology, intellectual property, or critical infrastructure, creates enduring value. We're in the middle of a structural shift where intangible innovation is merging with tangible impact. Clean energy, robotics, artificial intelligence, biotechnology, and decentralized systems are redefining what it means to own something real. These aren't speculative bubbles, they're the building blocks of the next industrial revolution. The volatility we're witnessing isn't destruction, it's recalibration. It's the market trying to rediscover what's real. During every technological transition, the early stages look chaotic. Prices overreact, confidence swings wildly, and narratives dominate over data. But underneath that noise, the seeds of exponential growth take root. What's real doesn't vanish in a correction, it strengthens. The innovators that survive are those anchored in real demand, real science, and real productivity. When you own real things, you own time. You're not trading on emotion or timing cycles, you're compounding growth built on substance. Over the long term, assets connected to real innovation outperform because they solve persistent problems. They aren't just stories, they're solutions. The market may undervalue them in the short run, but when cycles turn, reality reasserts itself. That's when tangible creation outperforms speculation. Today, as global uncertainty rises, geopolitical tensions, monetary shifts, technological disruption, the temptation is to retreat into cash or wait for clarity. But the truth is, clarity never comes first. The future doesn't announce itself. It emerges through conviction in the face of noise. The investors who understand this know that real wealth isn't built by reacting. It's built by holding what the future will demand more of. Consider how the past century unfolded. Those who owned productive assets during technological revolutions, steel, electricity, semiconductors, the internet, didn't just survive volatility, they multiplied their influence. The same pattern is repeating now, only faster. Real things today are not just physical, they're deeply technological. Software that drives efficiency, energy systems that reduce costs, data infrastructure that connects the world. These are the modern equivalents of owning land, factories, or oil fields. They generate value through use, not illusion. The coming decade will test what's real and what's not. Artificial valuations, financial excess, and speculative trends will be exposed for their fragility. What will remain are assets tied to innovation, creativity, and productivity, those that create measurable progress. The transition will feel uncomfortable, as it always does when paradigms shift, but in that discomfort lies opportunity. Owning real things is not just about preservation, it's about positioning for the next expansion. In every transformation, there's a moment when trust in symbols fades and trust in substance returns. That moment is here. You can see it in how investors are reevaluating companies, how nations are reassessing resources, and how technology is redefining ownership itself. What we call real is expanding beyond physical matter. It now includes systems, networks, and technologies that make the physical world more efficient. That's where durable value is forming. This is not a call to abandon innovation. It's a call to ground it. Real ownership means understanding what drives productivity at its core. It means holding what humanity can't outgrow. In a time when money moves at the speed of information, the ability to create something that endures becomes the ultimate store of value. So as the next economic phase unfolds, the question isn't how to avoid volatility, it's how to align with progress that transcends it. The most successful investors of this era will be those who don't chase illusions of wealth, but anchor themselves in the reality of creation. Because in the end, no matter how digital the world becomes, value will always flow toward what is real. Owning real things isn't just an investment strategy, it's a philosophy of resilience. It's about believing that substance outlasts speculation, that innovation built on real, world impact will define the next era of growth. And as the global system resets once again, those who hold what's truly productive won't just protect their wealth. They'll shape the world that comes next. In every period of disruption, one principle quietly separates those who endure from those who don't: diversification. Not the kind that simply spreads risk across numbers on a screen, but the kind that recognizes the world is changing faster than any single idea, asset, or currency can keep up. True protection isn't found in uniformity, it's built through exposure to multiple forces of innovation, across geographies, technologies, and time horizons. The future rarely moves in a straight line, and those who understand that adapt long before others even notice the curve. Diversification is not about fear, it's about readiness. It's an acknowledgement that the future unfolds in unexpected ways. Markets shift, technologies evolve, policies change. Entire industries that once looked unshakable can collapse overnight. But when your exposure is spread across ideas that are shaping tomorrow, rather than clinging to what worked yesterday, you're not reacting to change, you're harnessing it. That's the power of diversification done right. We're entering a world defined by convergence: artificial intelligence, robotics, energy storage, genomics, and blockchain are not isolated sectors, they're overlapping systems. They amplify one another, but that also means concentration in any single narrative carries unprecedented risk. The same innovation that creates exponential upside can also render old models obsolete faster than ever before. Protection, therefore, isn't about avoiding innovation, it's about balancing exposure to the right mix of it. Think of it like an ecosystem. In nature, diversity ensures survival. A forest with one kind of tree cannot endure disease or climate stress, but one filled with a spectrum of life adapts and regenerates. The same principle applies to portfolios, to economies, even to nations. When everything depends on one stream of growth, one source of energy, or one system of trade, vulnerability multiplies. But when growth comes from many sources, when creativity and technology intertwine, resilience compounds. In moments of uncertainty, people tend to retreat into what feels safe: cash, a single asset, or a single idea that once worked. But safety built on familiarity is often the most dangerous kind. History reminds us that concentration feels secure right before it fails. The investors who survive paradigm shifts are those who prepared for multiple outcomes. They hold innovation and stability, growth and defense, present returns and future potential. That is real diversification, not just across assets but across time itself. Technology is accelerating faster than any model can fully capture. Entire industries are being rewritten by code, by data, by learning systems that improve with every transaction. That velocity of change means protection must evolve too. The most effective shield isn't built from rigid walls, it's built from optionality. The ability to move, to pivot, to benefit from disruption instead of fearing it. Diversification gives that freedom. It allows you to absorb shocks and still participate in what's next. This decade is teaching us that protection is not passive. The world is too interconnected for that. Every market, every region, every technology affects the others in ways we've never seen before. A policy change in one country ripples through global supply chains. A breakthrough in one lab shifts capital across continents. Diversification acknowledges that interdependence. It's not an admission of uncertainty, it's a recognition of reality. The greatest risk today is overconfidence in what worked in the past. For decades, portfolios optimized for one economic environment: low inflation, falling rates, and global integration. But those assumptions are being rewritten. The next phase will reward those who are exposed to new productivity engines, to innovations that create deflation through progress, not contraction. That's where protection meets growth, in the assets that benefit from change instead of resisting it. Diversification isn't about owning more, it's about owning meaningfully. Each component should represent a different vision of the future. When one falters, another rises. When policy hinders one industry, innovation unlocks another. That dynamic equilibrium is what sustains compounding through decades of volatility. And when disruption accelerates, as it always does near inflection points, those with diversified exposure will not only preserve their capital, they'll capture the upside of transformation. To diversify effectively is to stay humble before the future. It's an acknowledgement that no one can predict exactly how technology, geopolitics, or demographics will evolve. But it's also an act of conviction, the belief that humanity moves forward through creativity and adaptation. When portfolios mirror that adaptability, protection becomes participation. You're no longer hiding from risk, you're aligned with progress. The coming years will test the structures built on concentration, whether in markets, industries, or ideas. Those who thrive will be the ones who spread their roots widely, across innovation and stability, across the known and the emerging. Because the next era of growth won't be linear, it will be exponential, unpredictable, and profoundly diverse. Diversification is not the absence of conviction, it's the amplification of it. It's how you stay invested through transformation without being defined by any single outcome. It's how you protect against decline while positioning for discovery. The most powerful portfolios, like the most resilient systems, are not built to stand still, they're built to evolve. So as the world moves into its next cycle of creative destruction, remember this: protection is not retreat, it's preparation. Diversify not out of fear, but out of faith in what comes next. Because the future doesn't belong to those who guess perfectly, it belongs to those who are ready for anything. The most powerful forces in the economy are the ones we rarely see in the moment. They unfold quietly, over decades, shaping everything from interest rates to innovation. Short-term noise often distracts from long-term truth, but those who step back, who think in cycles rather than snapshots, recognize that what feels like chaos is often just the turning of a larger wheel. The key to navigating uncertainty isn't predicting the next move, it's understanding the rhythm of time. Long-term cycles have always governed progress. Every era of expansion is followed by a reset. Every contraction clears the path for a new wave of growth. Human behavior, technology, and capital all move in patterns, repeating in form though never in detail. The industrial revolutions, the information age, the rise of digital networks, all began in periods of doubt, when old systems could no longer sustain the weight of innovation. We're in one of those moments now. The world is rebalancing after years of excess, setting the stage for what comes next. Short-term volatility often masks long-term opportunity. When you look at data through the lens of months or quarters, you see turbulence. But when you zoom out across decades, the picture changes. It reveals a pattern of progress punctuated by disruption. The cycles of innovation and capital have always worked that way: overinvestment and excitement, followed by disillusionment, and then the quiet compounding of real value. Each reset is a signal, not an ending. We're living through the late stages of one such cycle. Decades of easy money and globalization inflated asset prices and created dependence on policies rather than productivity. That model is now unwinding. The system is searching for balance, pushing capital toward the real engines of growth: technology, efficiency, and innovation. It may feel uncomfortable, but discomfort is what precedes renewal. The market isn't breaking, it's recalibrating. Thinking in long-term cycles requires patience, but more importantly, it requires context. When you understand that every economic boom contains the seeds of its correction, and every correction the seeds of its next expansion, you stop fearing downturns. You start seeing them as preparation phases. Innovation doesn't stop when markets fall, it accelerates. The builders keep building. The long-term thinkers see mispricing as opportunity, not threat. Throughout history, the breakthroughs that reshaped humanity emerged in periods of constraint, not comfort. The railroads were built after the panics of the 1800s. The internet grew after the tech bubble burst. Energy revolutions always follow crises of scarcity. These aren't coincidences, they're structural patterns. Innovation is the economy's natural way of healing itself, of creating new productivity to replace the old. The long-term cycle is simply that process repeating through time. We're at the intersection of multiple long-term transitions: energy, technology, demographics, and geopolitics. It's easy to see friction, but beneath it lies massive creative potential. The convergence of artificial intelligence, robotics, genomics, and digital infrastructure is setting up the next multi-decade growth curve. Just as electricity and computing once transformed the world, these technologies will reshape every industry, and history shows that the greatest returns come from understanding the beginning of a cycle while others focus on its noise. The challenge, of course, is psychological. Humans are wired to react to immediacy. We feel the pain of short-term losses far more sharply than we perceive the power of long-term compounding. But every great transformation rewards those who can look beyond quarters and headlines. Long-term cycles aren't just financial, they're behavioral. They test conviction, patience, and vision. To think in long-term cycles is to accept that progress isn't linear. It comes in waves, each one building on the last. And while the surface often looks volatile, the underlying trajectory points higher. The question isn't whether disruption will continue. It's whether you're positioned to benefit when it does. The biggest risks come not from the downturns themselves, but from misunderstanding where you are within the cycle. Today's uncertainty feels familiar because it is. The world has seen versions of this before: debt overhangs, tightening liquidity, shifting power structures. Each time the cycle resets, and each time innovation carries us forward. What's different now is the speed at which it's happening. Information flows faster, adoption curves shorten, and what once took a generation can now happen in years. This acceleration doesn't change the nature of cycles, it amplifies them. Patience then becomes a superpower, the ability to stay invested, intellectually and financially, through transition separates those who capture exponential growth from those who miss it. Thinking long-term means embracing volatility as the cost of progress. It means recognizing that the most profound shifts happen quietly, beneath the surface, long before they're visible in metrics or market caps. The cycle we're entering will likely redefine productivity itself. The fusion of human creativity with machine intelligence will open frontiers we can barely imagine. But the opportunity will belong to those who saw the pattern early, who understood that every correction is the soil from which new growth emerges. The temptation will always be to chase the short-term trend, but progress doesn't reward reaction, it rewards vision. Thinking in long-term cycles allows you to step above the noise and see the economy not as a series of crises, but as a living system constantly evolving toward higher efficiency and greater abundance. So as the headlines grow louder, take a step back. Remember that this moment, too, fits into a larger rhythm. History doesn't move in straight lines, It moves in arcs, and if you can see those arcs clearly, you don't just survive the cycle, you align with it. Because the future isn't random, it's repeating in new forms. And those who think long term will be the ones shaping what comes next.